Welcome back to the Dental Startup Journey Show, where we bring you the guidance, strategies, and tools that you need to help you launch and grow your first dental practice successfully. I'm your host, Maritza Duran, and today we are diving into the financial side of starting your dental practice, one of the biggest make or break pieces of the puzzle. Joining me today is Danny Camarosano, the Regional Director of Practice Finance at Provide. He's helped hundreds of dentists secure funding to launch or expand their dream practices. And he is here to answer your questions or questions that you even didn't expect you didn't know you had about startup financing. So, whether you are still dreaming or already scouting for locations, this is a conversation that is going to give you the clarity and the confidence for your funding strategy. So let's get started. So, Danny, thank you again so much for joining me today. I'm super excited. My first question is, tell me about yourself and a little bit more about your journey.
Yeah, absolutely. I appreciate you having me on. Again, my name is Danny Camarosano. I'm a healthcare specific lender at Provide. So I specialize in lending money to dentists and doctors looking to start, buy, or grow their own private practices. Again, I work at Provide, which is a part of Fifth Third Bank, and we focus entirely on financing healthcare professionals all across the country. I'm based in New Jersey. I work with clients nationwide. I do a lot of hands-on work with borrowers right here in my region. I've been in banking for 20 years, and for the last 8 years, I've been doing this, just focused specifically on doctors. It's mostly dental, but I'm also working with some optometrists, medical doctors, some vets. And what I love about my role is that it's not just about getting someone a loan. It's really about more. It's about helping them understand the business side of private practice, guiding them through like one of the biggest financial decisions that they're ever going to make. So I try to take a more consultative approach, whether it's, just with someone who's starting to explore ownership, or if they're already deep into the process and just trying to decide between different options. So I've helped hundreds, maybe even thousands of doctors over the years, from
That's
startups
amazing.
to expansions. Yeah, so I just look to help people make good decisions and ultimately bring their vision to life.
I love it. Now, a question that always comes to me, and I'm going to ask you these questions from the perspective of a dentist, and I can basically relate to them as understanding the lending world. So excuse the questions, but these are questions that I think that our doctors will appreciate, to bring them to that level so that they can understand. Because
Sure.
we're talking about lending, and you said something really important, which is one of the biggest purchases or investments in their lifetime. And so they want to be able to make informed decisions. So what I would love to ask you, this is a question that comes to me all the time. What's the difference between an SBA loan, conventional loan, basically the options that are available for doctors, and how should dentists evaluate which one is a better fit for their needs?
Sure. It's a loaded question, but first, I guess let me just address what the SBA actually is.
Sure.
People hear those letters all the time, but might not actually know what they mean. So the SBA itself, the SBA stands for Small Business Administration. So that's a federal government agency that has a stated mission to aid, to counsel, to assist, and to protect the interests of small businesses across America. So that's a pretty vague statement, right? So how do they do that? Well, one of the major roles that the SBA plays is making capital available to small businesses in a ton of different situations where otherwise those small businesses wouldn't be able to get funding from a traditional bank like mine.
Okay.
But the SBA is not a direct lender. They don't actually lend money to people directly. The SBA uses the banking system to make money available for small businesses, and they do that by guaranteeing a portion of loans that are issued by banks. So, in other words, the federal government basically comes to a bank like Fifth Third and they say, if you make a loan that looks like this, and they give us an 800-page document that spells out all of the requirements that are needed to qualify for an SBA guarantee, then that loan is eligible for the federal government to guarantee 75% of the risk on that loan. So it basically reduces the bank's risk. So then the bank's willing to do some things that otherwise we just wouldn't be willing to do based on our own risk parameters. I'll give you an example, right? So like
Sure.
most small businesses in the country outside of the healthcare industry are funded by SBA loans. Like if I wanted to go start a business tomorrow, let's say I wanted to open a restaurant or a
I
consulting.
have an SBA loan.
Oh,
That's yeah,
see, I was going to say like a consulting business or whatever. I have no previous history of being a business owner, so that's a lot of risk for the bank. So the bank might be willing to lend me the money, but they're only going to do it if they get the government to guarantee the loan.
makes sense.
Now, the healthcare industry, and even more specifically, the dental industry, is a big exception to that rule. It's one of the only industries that can get a startup loan without the SBA being involved. And it's simply because banks love dentists. Dental practices are incredibly resilient. They're stable, they're profitable, they're predictable, they're recession resistant, margins are strong. I can go on and on. But they're usually pretty responsible borrowers, and the default rate is extremely low. It's almost non-existent. And so because of that, we usually don't need an SBA guarantee to get a startup loan approved for a dentist who's leasing a space and doing like a small to medium sized build out. But again, there's exceptions to the exception where we would still seek an SBA guarantee on a startup loan for a dentist. One is if the funding need is just larger than your normal, typical, 5-op practice, and if the business plan justifies it, right? So an example, we just helped an oral surgeon build out a 3,800 square foot, beautiful state-of-the-art facility, and he borrowed $2 million to do it. It's a lot of money, but he had an amazing business plan, had great projections, showed us why borrowing $2 million was a good investment and that there'd be a return there. Or another situation that's probably more common is when a startup dentist is looking to buy their real estate along with the practice instead of just leasing. Sometimes we'll seek an SBA guarantee on that because then the borrowing need gets bigger than what the bank is typically comfortable with. So either way, SBA lending can be a really powerful tool, especially early in your career. How do you know which one's right for you? I mean, I hate to give a cop-out answer, but it depends, right?
Okay. That's a fair question. Every situation is different, right? So you have
Exactly.
options. That's basically the whole point. Or what I'm understanding is that there are different options, and then you help doctors explore whichever one it's suited for their needs based on what they're looking for and their situation. So
That's right.
so conventional loans, which is what's the slight difference, if any?
So a conventional loan is not backed by the government. It's just the
Okay.
bank willing to take that risk.
Okay.
Because of that, it's faster, it's easier, it's more common, but it doesn't give you the flexibility to do the same things that an SBA loan would give you the ability to do.
Perfect. Makes sense. Another question that I wanted to pick your brain on today, or that I hear often from startups is, how do I know when, if I'll even get approved, right? Like, so can you talk to us about some of the main factors that lenders like yourself and at Provide evaluate when, in order to determine to approve a provider, or if for how much to approve a dentist seeking to start their first practice?
Yeah, absolutely. Great question. A lot of borrowers assume that the approval is all about credit score or just about how much money you have in the bank. Those things definitely matter, but they're just part of a bigger picture. So when a lender like us evaluates a deal, whether it's a startup, an acquisition, an expansion, real estate, whatever it is, we're looking at, in general, two major things. We're looking at the borrower.
Okay.
We're looking at the project that they're trying to do. So on the borrower side, it's mostly about financial profile. We look at
Okay.
credit history. Credit history means credit score, but not just credit score. It also means like the patterns that go into that score. So, are they making their payments on time? Do they have collections, charge-offs, bankruptcies? In general, like have they shown that they're responsible with their debt? And a good credit score helps, obviously,
Okay.
but it's more about the behaviors and the trends that go into that score. Um, Liquidity is extremely important as well. How much cash or investments do they have on hand, not including their retirement? And liquidity is important, especially for startups, because the bank wants to know that you have a cushion
Yes.
in case the business takes longer than expected to ramp up, or if there are unexpected costs that come up. We want to make sure that we're not putting someone in like a tight spot.
Yes.
We look at existing debt, right? Like, what are their monthly obligations on other loans, like student loans, car payments, credit cards, mortgages? Because every dollar that you need to pay someone else is a dollar that you can't pay us at the end of the day. And that all goes into something that we calculate that's called a debt service coverage ratio.
Okay. I'm
That
gonna start making notes.
So the debt service coverage ratio, you don't need to worry about the calculation. We'll do all the math, but it basically, in a nutshell, tells us how easily our borrower can afford to make their monthly payments.
I see.
That's the gist of it. So even if a practice is cash flowing well, like for example, in the situation where someone's buying a practice, even if that practice is cash flowing really well, we need to make sure that that person can afford their monthly payment. So the calculation is different from borrower to borrower. We want to make sure that that person can afford to take on a new loan and still maintain their current lifestyle. We also look at like clinical background, professional background, like how long have they been practicing? How are they producing as an associate? Do they have leadership experience, even if it's kind
That's
of
interesting.
informal? Yeah, all that stuff matters to us, because we want to understand your ability to succeed, not just as
Overall.
a clinician, but yeah, as a business owner as well.
Beautiful. So what are some of, just a follow-up question on that? What what are some red flags that could basically hurt someone on their approval process? Like if you were to, like someone watching right now is thinking, hey, do I have enough liquidity? And I have some specific questions on that. But like if someone wants to start preparing for getting into the journey of starting their first practice and have questions about their ability to get approval, like some of the myths is like I need to have my student debt somewhat under control. So what are some of the red flags, and what advice do you give someone that it's thinking about doing it and it's unsure whether or not they're going to be eligible?
Yes, I would say the best way to know is honestly speak to a lender. Like, I have people who make assumptions every day that, some people underestimate themselves and think that they can't get approved when, you know, all they need to do is talk to us and we'll guide them and let them know, like, actually, you're in a good spot. You're in a better spot than you thought you were. Um, but red flags, I mean, obvious ones that we kind of just touched on is like bad credit. I'd say anything, even like borderline bad credit, anything under a 700 is something that you need to work on. Try to get that score over 700. Um, you know, we can lend to dentists directly out of school or out of residency, but you better be super strong, either financially or clinically, or there better be some reasons why you want to get started directly out of school. So I'd say not necessarily a red flag, but something to just consider is like you want to have some real private practice experience, get out into the real world, start working, start showing the ability to produce in a private practice setting um, before you approach the bank. Uh, Other things like liquidity, the more money you have saved, the better off you're going to be in terms of not just getting approved for the loan, but just in terms of making yourself comfortable as you enter into practice ownership. Um, and other things
This
are
is
like,
really great advice. I mean, I love it. These insights are amazing. Thank you.
I appreciate that. And like high monthly payments, like I say to everyone, look, when you get out of school, especially as a dentist, like you have the ability to make a pretty good living for yourself as an associate. Um, and that's exciting and that's awesome. But, try to keep your expenses reasonable. Don't go buy a Bentley just yet. Nothing wrong with driving a Honda for a little while. I say that facetiously, but I mean it. Like every dollar that you're spending somewhere else is a dollar that can go towards your practice loan. So if you look, there's nothing wrong with driving a Bentley, and if you can afford to do it, then great. But if you have aspirations to be a practice owner and you're going to look to the bank to lend you money in the future, or even in the like not so distant future, just take those things into account. Know that that will affect your ability to borrow money. Every decision that you make, every time that you hit your credit, and whether you're spending on credit cards or you're borrowing to buy a car or even a home, just know that that can impact your ability to borrow in the future.
That's great. Now, another question that comes is there a difference, right? Like another decision, I guess, that dentists need to make for their startup journey is real estate. A lot of doctors are always thinking or are not sure about their options, and they're they're debating on whether what's better. Is it better to lease? Is it better to purchase a property? So for how does their choice of whether it's real estate owning or signing a lease basically affects their financial options? Is there anything that that is there a difference between the two options in terms of their ability to finance the project?
Sure. Probably similar to yourself. That's one of the most common questions that I get with startup doctors. Like, should I buy? Should I lease? I would start by saying, even beyond financing, start or lease, what's the right answer? Like, first of all, I think it's the wrong question to be asking, at least at first. The focus shouldn't be on, do I lease, do I buy? It should be on finding the right location.
I agree with you.
The most important factor in the success of a startup practice is where
Look,
you are and who you're serving, right? If you're in the wrong spot, it doesn't matter whether you own or rent, you're going to struggle. So first priority should be finding a location that has strong demographics, demand for the services that you're offering, the potential to grow. And once that's locked in, then the question is, okay, do I have the opportunity and the financial capacity to buy the building? And so let's break down both sides, right? So leasing, that's the more common path. It's obviously less money up front, it's faster, more flexibility, right? If things change in the future, if you outgrow the space or if you want to expand, you have more flexibility to do that. So a lot of my clients just choose to lease just to keep things simple, to preserve their capital during the early years. Buying, obviously, it's a longer term investment. You're building equity, you control the space. You're not at the mercy of a landlord raising rent or deciding like they're not going to renew your lease at some point. So if you know that you want to be in that area for the next 15 to 20 years and the opportunity's there to purchase that real estate, then it absolutely can be a smart financial move. Both are totally doable. Leasing, buying. If you're leasing, you're going to get one loan. It's going to be entirely based on the practice. You're going to get enough money on one loan to do your build out, purchase your equipment, give you working capital to operate your practice, marketing, consulting, other soft costs. If you're buying the real estate, we'll typically structure that as two separate loans, one for the business and then one for the building. We underwrite it based on the combined monthly payments to make sure that it's affordable. And then one thing to be aware of, buying the building typically does require a down payment. So you're going to need to put in anywhere from 10% of the total project or 15 to 20% of the real estate, depending how we structure it. And back to the SBA conversation, that's where the SBA sometimes becomes useful, because if the total loan amount becomes high enough, the SBA gives us the ability to move forward without putting too much strain on the borrower.
Yes, I remember we have a project recently where the doctor decided to purchase the space, and we had to go through the whole process of the SBA, the projections, and all of those things. So, this is great, and that brings me again. Now that you mention when a doctor is exploring the option of potentially purchasing, and they have to have the liquidity planning, right? So let's talk about savings, which is one other big component of their their need to be able to have a peace of mind and know that they're going to be making this investment for the long run. But at the end of the day, they still have a lifestyle. They still have expenses. So let's talk about like how much liquidity should a doctor aim to have before jumping into the startup process in your recommendation?
Sure. So I'm going to touch on a few things here, not with this statement, I guess, and it not just on liquidity, but you mentioned something with business planning and projections. I'm also going to touch on insurances here, in a broad statement, and just saying that there's a big difference between what the bank requires and what you should actually have and what you should actually be doing.
Hmm.
From like a liquidity perspective, from a for a startup, the general rule of thumb is that we want to see at least 10% of the total amount that you're
You're
borrowing
borrowing. Okay.
in liquid assets, non-retirement. So if you're borrowing $750,000, we want to see that you have at least $75,000 saved.
Mm-hmm, mm-hmm.
For an acquisition, that amount is a little bit more flexible. We're usually able to go down to like 7% because you're walking into a situation with
Cash flow.
cash flow. Um, but again, that's minimum from the bank's perspective. If it were me personally, I wouldn't want to just have the bare minimum.
Of course.
I'd want to have more than that, especially if you're doing a startup. You know, I always tell people it's a business. Every business has unknowns. No matter how solid the plan is, things get delayed. Construction can run over budget. Marketing can take time to
Mm-hmm,
gain traction.
mm-hmm.
Life happens, right? You get sick, you take time off. Things just don't always go according to plan, and your business still needs to survive at the end of the day. So for a startup, for me personally, I usually recommend that people should have at least 12 months of personal living expenses saved
Okay.
before jumping in. Again, not a bank requirement. We're not going to like look at those and say that's what you need, but like, I I don't look at myself as just like let's do what it takes to get you approved. I look at let's do what it takes to make you super successful in the long run.
And that's one of those things that I'm always I mean, I've known you personally for so many years, and one of the things that I appreciate a lot of you is your ability to connect and build a relationship with the clients, where lending and your financial situation as someone that wants to fund a dream of owning a practice, it's intimidating, right? We feel a little bit, and I'm speaking on behalf of doctors because they're just like individuals that are going about their careers, and they have this dream, they have this vision, and a lot of times it's almost like you don't know what you don't know. And the financial institutions could be a little scary for us to just get in there and get familiar with the numbers or get some sort of like financial health check for ourselves. So like, I appreciate that you're taking the time to do this for me. And so that brings me to the follow-up question, or the next question that I have is, there are a lot of banks, and there are a lot of offers, and naturally, like, everyone is always going to look at the interest rate first, right? Because that's what we're trained or programmed to always look after, right? But how can someone evaluate and compare loan offers more like in a more holistic way, like where you're taking consideration the terms, but also um, do it in a way that that makes more sense, and that, again, the simple word is just that it's holistic, right? Like, it's not written by the books.
Yeah, I'm glad you asked. You're right. Interest rate tends to be one of the only things that people tend to focus on. It is absolutely extremely important. but it's not the only thing that matters. It's one piece of the puzzle. Um, a lower rate doesn't even necessarily mean that you're, first of all, it doesn't mean you're getting the better deal. It doesn't even mean you're paying less interest, believe it or not.
Hmm.
So here's how I would think about comparing offers. You have to look at everything, right? There's at least a dozen or more things on a loan offer that you need to take into account. First of all, look at how much each lender is actually willing to lend you, right? Are they covering 100% of the project? Are they asking you to put more money down? Are they including everything, working capital, soft costs, marketing, consulting? Or are you going to need to come out of pocket for some of those things? Like sometimes a bank will give you a slightly lower interest rate, but they're not funding everything you need. And you know what? If you have the liquidity to cover it, maybe you're okay with that, but maybe you're not. So you need to think about it. The other thing is like if it's a startup or any type of construction project, look at how your lender is going to handle your disbursements, right? Are
Okay.
they just going to leave it up to you to manage the project? Are they going to work with you and your team to manage the budget, to make disbursements easy on you? If costs increase during the build out, or if you need more money, can they adjust? Are they good at adjusting on the fly? Ask how they treat cost overruns, delays. Because in startups, as you know,
Hmm.
things happen all the time.
Yep.
Um, like, does your lender have a reputation for being inflexible and things like that? Things like that. Have they been able to help other people navigate challenges in the past? Like, ask around, ask your colleagues. Then look at your payment structure, right? Do you need to make payments right out of the gate? Is your interest accruing and compounding during the project period? Once you open your practice, like, are you getting a period of low payments while you're ramping up? Some banks offer that, some banks don't, right? And so you can have the lowest rate in the world, but if you walk into your practice and you have no patience and you've got a practice loan that you need to pay eight, nine, $10,000 a month, cash flow might be tight. So you want a loan that gives you flexibility to grow with those payments. And then there's obviously the fine print, right? There's fees, prepayment penalties, amortization schedules, um, things as simple as like an interest rate. Make sure you're comparing apples to apples. Some lenders quote an interest rate, but they use a 360-day calendar instead of 365, which increases the amount of interest that you actually pay over time. So even though they're quoting you the lower rate, it's not the same thing. Um, Finally, like, I mean, I would look at the lender's experience and just the level of support that you're getting. Like, are they dental or healthcare specific? Do they know the people in the industry to get you the support that you need if and when you need it? Or is it just another small business loan to them? Do they understand the industry, the timeline, the risks? Are they going to help walk you through decisions? Um, one thing that people don't take into account in this type of transaction is it's not a one-off transaction. It's not a mortgage. Like, you're pretty much locked into your lender for the long term, because of prepayment penalties and because of your banking relationship and because of the complexities of refinancing. So you're not just choosing like a one-time vendor, you're choosing a partner. So you should feel confident that your lender is going to deliver when it matters most, like during closing, during construction, during delays, during those challenges that every project has a challenge. And you want to make sure they're also going to deliver after you're open, right? The early months of ownership, when everything's still new, when you're open for business, like, what bank is giving you the best service? Who's giving you the concierge white glove treatment? Who's treating you like a number, right? Who's going to answer the phone? Who's going to answer text? Who's going to be responsive when your online banking password won't reset and you're sitting chairside trying to plan treatment for a patient and you don't have time for it? Who's going to push you off to an 800 number? Like, those things
Yes.
matter. So yes, you should look at the rate, but you should also look, like you said, holistically at the total package: payments, disbursements, service, relationship, like, and who's going to be there for you in the long term.
I really love your approach. And this conversation with you has been insightful. It's very educational, and it's almost like you're consulting. So I love that. I truly do. And before we wrap up, I just want to, for those who are watching and listening, that are considering or thinking, they're just getting started on their research. I want you to leave them with one piece of advice, right? About how to set themselves up financially for success.
I would say make sure you have the right team around you.
Mhm.
Um, speak to speak to as many people as you can, but make sure you have a really good team. And this isn't, it might sound self-serving, it might sound serving to you, Maritza, but I mean it, like the advice and the support that you can get from a really good consultant is invaluable. Um, Again, I have to plug Maritza because she's a friend of mine and we do a lot together. She's the best, if not one of the best in the entire country at this. But even if it's not Maritza, like get a good consultant, go into this with support. And same goes for your lender. Like obviously I would love to work with as many people as possible, but even if it's not me, there's a lot of good lenders out there at a lot of different organizations. Make sure you're working with someone who has your best interest at heart and is going to support you through the entire process. Um, and the same goes for like the whole team. Your real estate agent is going to play a really big part, your attorney, your CPA, and your financial advisor. And there's probably, 10 other different types of people that I'm not thinking about, but I would say
It's
that's
an army. It's definitely an army of a team of advisors that they need, and starting with you, starting with the lending, which is the most important piece, because without you, there is no project, right?
sure. Well, without me or another lender, but hopefully it's me.
So, Daniel, thank you so much for your time and expertise advice today. I really feel that your insights are invaluable, and for first time practice owners who are navigating like the complex world of financing. And for those that are just listening, if you're dreaming of launching your first dental practice or even exploring growth opportunities, I do understand that you guys do offer have options and programs for both doctors who are launching their first practices, but also acquiring an existing location, right? I'm going to make sure that we have your contact information about Danny and provide through the links that we're going to have on the notes. And so, thank you everyone for joining me and watching this episode. Make sure that you subscribe and share it with someone that you know it's in this journey, because we want to make sure that you guys are set up for success. So thank you, Danny, for your time today, and until I'll see you next time.
Thank you so much for having me. I appreciate it.
And that's a wrap up for another value packed episode of the Dental Startup Journey Show. A huge thank you to Danny and the team of Provide for breaking down the financial process in a way that's easy to understand and empowering to act on. So, if you're a future practice owner and financing feels overwhelming and intimidating to you, remember, you don't have to do it alone. Reach out to a lending partner like Danny, who understands the dental world and can help you make smart strategic moves from day one. So, check out the links on the description and the notes to connect with Danny to learn more about your financing options for your startup. And as always, do not forget to follow, subscribe, and leave us a comment so that more dentists like you can launch with clarity and confidence. This is Maritza Duran signing off. Keep going, because your dream of launching your dream practice, it's closer than you think. Until next time.